Hello friends, this is the second part of types of life insurance policies. Uh, in this category, we have next set of policies on the basis of participation in profit. First is without profit policies or non-participating policies. Uh, the policy holders are not entitled to share the profit of the company. These policy holders or insured get only the sum assured. The rate of premium paid on this policy is mostly very low, right? Without profit policies or participating policies with profit. This is not without, with, ignore without, with profit policies or participating policies means in this particular segment, policyholder can share only the profit and not the losses. Therefore, they cannot be treated as co-owner of the company. Okay, and in this case, premium basically very high. Now, on the basis of number of lives covered, point number one is single life policy. Under this policy, only single individual person insured. This policy insure only one life, right? Then the next is multiple lives. In this policy, more than one life is insured. Then we have a joint life policy. This comes under joint life policy covered under that multiple life policy, right? In this case, husband and wife both insured his life. Okay, the policy amount is payable on the death of the first person, right? Either of the partner. If death occurred, either of the partner, the company will pay the sum assured as well as the principal amount. Under the multiple life policy, last survivorship policy, under this policy, the amount is payable at the last date. So long as any one of the insured is alive, no payment is made. Means both the survivor at the death of the last survivor, company will pay the compensation to the family only, because this is the condition. Then we have, on the basis of the payment of claim, we have lump sum payment, we have installment payment. Lump sum payment means the policy amount is paid in lump sum according to the terms and condition of the policy. And the second is installment payment. Under these policies, the policy amount is payable in installments. It is suitable to those whose earning capacities are reduced to minimum in later age of the person. Next is annuity. What is annuity? This is also a part of life insurance. Here, just understand the meaning. Annuity this is a separate question. Sometimes this question is separately asked in examination. Uh, Annuity is a form of pension whereby, in return for certain sum of money, the assurer agree to pay the annuitant an annual amount for a specified period. It means a life annuity may be defined as a contract under which the insurance company agrees, in consideration of certain premium or certain payment, to pay to the person who makes the payment a fixed regular income. The person during whose life is annually, whose life the annuity is paid, is called annuitant. Understand? I think my point is clear, or I can clear out in a very simple language. Once you pay the premium to the company, ultimately a regular income you can earn from the company. The person who make the payment is known as annuitant, and during whose life the annuity is paid is called annuitant. The price of the annuity paid by the annuitant at the beginning of the contract is called the amount of premium or amount of consideration. Kinds of annuity. Different types of different kinds of annuities available. Okay. First is annuity according to the commencement of the income. First is immediate annuity. Payment commence immediately after the end of the first income period. Okay. It means if the annuity is to be paid annually, then the first installment will be paid at the expiry of 1 year. If the annuity is half yearly, then at the end of every 6 months. In case of quarterly, at the end of that quarter. Annuity due. Under this annuity, the payment commences from the time of contract. The first payment is made as soon as the contract is finalized. Means, just try to understand, immediate annuity means at the end of the time period. Annuity due means at the beginning of the period you have to pay the premium to the company. Deferred annuity, uh, the payment of annuity commence after a fixed period or attainment by the annuitant of a specified age. Sometimes that premium may be paid on the basis of single premium only. Okay. So next category is annuity according to the number of lives covered. Similar, just like ordinary insurance policies, single life means one single person is contracted. This annuity is most suitable to those who have no dependent. This policy is good for them. Multiple life means under this policy more than one life is contracted with the insurance company. This is again of two type: joint life policy. The annuity payment or the payment of annuity stop at the death of the first person. Last survivor, the annuity payment continues up to the death of the last person. Then we have annuity according to mode of payment. First is level premium. Like the annuitant can deposit the premium yearly basis or quarterly basis to the company. On the other hand, single premium means you have to pay the premium to the insurance company once in the life or at the time when you purchase the annuity. Then we have annuities according to the disposition of the sum. So in this case, we have two categories. One is life annuity. Under this annuity, the regular income will be made to the annuitant throughout his lifetime. No payment is made after his death. Means regular income will be made to the annuitant. Income he or she can earn during the lifetime, but once death occurred, the dependent will not get any sum. Then guaranteed minimum annuity. Uh, in this case, life of annuity payment up to a period is guaranteed by the company. Up to certain time period, they give you guarantee, right? That guarantee may be immediate. In case of immediate annuity, uh, that guarantee, sometime I'm just clarifying this concept in a simple language. I'm trying. Yes, under this annuity payment for a fixed number of years will continue irrespective of the death. Instead of continuing the annuity payment after the death of the annuitant, the difference of the purchase money and the annuity installment, which already paid, is returned as a lump sum to the nominee. Simple. At the time of death. Sometimes this is deferred annuity. The payment will continue for a fixed period of time. say for 5 year, for 20 year, for 10 year, and up to the life thereafter. And the payment commences after the deferred period. The annuity also guaranteed the refund in case of the death. That's all for today. We will discuss further in the next section, other policies.